This is Shelley Kraft, and welcome to SNN Live. We're coming to you live from the Sprott Natural Resource Symposium 2017 here in Vancouver. I have with me Adrian Day. We're going to do a Wall Street view, and Adrian is Adrian Day Asset Management, and he's a speaker at this conference. Adrian, welcome to SNN Live.
Well, thank you, Shelley, for having me.
It's good to have you. Tell us a little bit about your management company first.
Well, the firm is called Adrian Day Asset Management. We started in 1991. We manage money primarily for individuals, also small institutions in the global area. We manage, in stocks, primarily equities, stocks around the world. We also have dedicated gold accounts.
So are you mostly managing these accounts with the purpose of buying resource companies, or is it across agnostic lines?
It's across the board. I mean, we own Nestle. We own tiny little, we own a company that makes exhibits and booths for shows in Singapore. We own anything and everything.
So what is your criteria for ownership in your fund?
Good question. I say we have three characteristics: long-term, value, and global. So everything we do is global. If we're looking at GM, we look at foreign car companies as well. We're long-term. By long-term, I mean 3 to 5 years minimum. But Nestle, for example, which I mentioned, we owned Nestle in 1991. When I started the firm, we still own it. If you own a really good company, you've got to have a reason to sell it, just as you have a reason to buy something.
So when you look at asset value, and you're here at a conference based on, obviously, resources, how do you value those assets to invest in them?
Wow, that's a really good question. We could probably spend 5 hours talking about that, because resources, and resources in general, are difficult. It's difficult to apply traditional value metrics to resource companies because, of course, resources are by their nature inherently cyclical. If I'm making widgets and I'm selling them at $10 a widget and my production cost is $9, I can maybe get it $9 down to $8.50 and my profit goes up 50%. If I'm in the resource business, gold might be at $1,200 and I'm producing at $11.50. But my gosh, if gold goes to 15 or 16 or 1700, suddenly my profits zoomed. So it's very difficult to apply traditional value metrics. Graham and Dodd, Benjamin Graham and his partner, probably wouldn't find many value stocks in this room.
So let me ask you another question. So do you get into biotechs and medtechs and life science and healthcare companies?
I have one fundamental principle in investing, which is don't invest in anything you don't understand. So I'll say no in answer to your question, which means I just don't understand it. You can't know everything. We invest in banks, health food companies, copper companies, gold companies, but you just can't know everything. And biotech I don't invest in.
I had a feeling that you didn't. So I wanted to ask that question because I wanted to clarify it. Now I'm going to ask you another, probably a little bit off-the-wall question. In this day and age, with so many companies going out as private companies and raising money, are you adjusting your model to purchase private companies, not private placements in public companies, but private companies themselves?
Well, primarily our firm invests in public companies, and the reason I think is quite simple. We have retail investors. People might give us $100,000, $200,000, $300,000 to manage, which might be the person's entire or half of their retirement fund. So we have to keep liquidity. We do invest in private companies. They're normally pre-public, and I don't mean a company that's going public next week, but I mean a company that has a goal of going public in 2, 3, 4 years. So we have invested in some of them. We had a very successful investment in a private university, for example, that was private for about 7 years. But most of what we do is in public equities for the liquidity.
So I have to ask you, the market, the U.S. market, and most of the world markets are trading at all-time highs. Are you still bullish? Are you still in there buying? Are you taking profits in certain? I mean, this is not. People say, "Oh, this is easy. You just throw a dart and you make money." We know that's not true. Explain.
Well, absolutely. And one thing to understand is when you're investing, a lot of people say, where do you think the market's going this year? To me, that's an irrelevant question. It's not a matter of making a prediction on where you think the market's going. It's a matter of looking at the risk reward and trying to assess the balance between the risk and the reward. So I would say in the US market right now, the risk has increased significantly. And we're buying very, very little in the U.S. market right now. We're not buying a lot in Europe right now because I think the risk has gone up in Europe as well, even though the stocks are cheaper than the U.S. We are buying in the major Asian economies, and I don't mean Japan and I don't mean China, but Hong Kong, Singapore. We're finding some very good values there. Stocks trading at 1 times book and 8 single-digit PEs and yielding 4, 5, 6% and so on. So we are buying there. I would say in very broad terms, if someone gave me, let's say someone gave me $1 million at the beginning of a year for global markets and they were conservative, we've still got $500,000 in cash, minimum. Someone gave me $1 million for gold and they gave it to me right now, it will be gone by the end of a week. There are tremendous values in the gold space, and I'm exaggerating a little bit, of course, because you never put all your money to work immediately at one go. But there are tremendous values in this space, I think, in the resource space right now. So we're rotating out of the U.S. market into some of the smaller markets, like Hong Kong, Singapore, and then into resources as well.
My question for you is, what are you speaking on at this conference?
I'm talking about gold under Trump, and that's just meant to sort of make people look. I'm talking about how President Trump's policies are likely to affect the gold market in the next couple of years.
So, can I have a little sneak peek at that?
I think there's some pluses and minuses. I mean, the truth is, as we know, he came into office, there was an awful lot of optimism. Frankly, there was a lot more optimism than I thought there would have been. But the optimism, particularly among small business owners, was based on tax simplification, tax cuts, less regulation. Regulation being a very, very critical thing for small businesses. Well, if he had been able to do those things and not get distracted by a lot of this other stuff, if he had been able to do that, that would have been incredibly powerful for the U.S. market, for the U.S. economy, for the U.S. market, and therefore negative for gold. But it looks increasingly as though we're not going to get what I call the best of Trump. We're not going to get those good economic policies passed, and we're winding up with a slightly dysfunctional Congress, a dysfunctional administration, an administration that's getting into arguments with every country around the world, even his friends. That's positive for gold. So I think we're seeing a shift now from that positive on the economy, negative for gold. We're getting that switch over to positive for gold.
Let's get your website out for more information, if you would.
Oh, well, that's very nice of you. It's www.adriandayassetmanagement.com.
Ladies and gentlemen, Adrian Day. This is a Wall Street View on SNN Live from Adrian Day Asset Management. He's a speaker at the Sprott Conference. I'm Shelley Kraft. This is SNN Live, and we're coming to you live from the Sprott Natural Resource Symposium 2017 here in Vancouver. Adrian, what a pleasure.
Thank you very much indeed, Shelley. Thank you.
Thank you.